IFRS S1, it is a general, the general one. What you are looking at is general sustainability related risks. You are looking at things, for example, like your labor practices. You are looking at things, for example, like your interaction with society. Do you pay your taxes? Do you have good governance? Not just corporate governance, but in terms of the way you govern yourself against society. Are you using child labor, for example, or even slave labor? It's not out of the context of some of the things that we hear on CNN, and uses financial materiality to affect value for investors and all providers of credit or finance to the company. So it's not only investors that are interested in finances. The bank is interested in your finances. Your bondholders are interested in your finances, as well as your shareholders, those who invest. Anybody that is putting their capital at risk for you, they want to see the financial materiality of your general sustainability risk. It applies the 4 pillars that we've spoken about that we've spoken about, 4 pillars of disclosure that we've spoken about. Now, the other thing I want to say is, before I say it, I'll go into the climate-related risks and opportunities. What we're focusing on there is the climate-related risks and opportunities that you have. And those can be physical risks, such as in Lagos recently, you see all the flooding that we have. Companies that were affected by that flooding, obviously, that's a climate-related matter for them. Or heat. In some parts of the world, there's been significant global warming. It could also be transition risks. For example, that you have a regulator that is saying, I need you to get to here to certain level of emissions from point A to point B from 2025 to 2030. I need you to reduce your emissions. And if you don't do that, there will be a financial penalty. That's a transition risk. There's a penalty involved. There's something coming from outside that's saying you need to transit from this way of doing business that is very emission focused to another way of doing business that is less emission focused. Then, of course, you are talking about scope 1, 2, and 3. In the interest of time, I'm not going to define necessarily what scope 1, 2, and 3 is, but maybe I can have a question and I can respond to it in the chat. Then you are using the GHG, the greenhouse gas protocols, with respect to reporting on those your scopes of emission. There's also scenario analysis to test resilience, and then you're also looking at climate-related opportunities. With respect to S1, which is the baseline standard, right? Where there's no topic standard that exists, then you refer to the SASB standards, which have been in existence for some time. And they have both industry and cross-industry standards there. I want to go to my next page. What is happening? I seem to, okay. Now, in the Nigerian context, as you may know, we have a roadmap that has been created by a regulator, the FRC. Now, that regulator Nigeria was the first country through the regulator, the FRC, to pledge that it will early adopt the IFRS standards. And it then created an adoption readiness working group. And that adoption readiness working group made a recommendation to the FRC around how to adopt the standards in Nigeria. And the FRC accepted some, and anyway, it came out with a roadmap thanking the Adoption Readiness Working Group for its work, and came out with a roadmap that took into account a lot of the things that the Adoption Readiness Working Group had recommended. And what the recommendation was that we should start an early adoption period, which was folks that reported on 2023 sustainability risks and opportunities in 2024. And then between 2024 and 2027, there should be a voluntary adoption for PIEs. And from 2028, mandatory adoption for PIEs, as you can see on the screen, 2030, mandatory adoption for SMEs. So this covers both public interest entities and SMEs. It means that everybody that has a company in Nigeria that is an SME or that is a public interest entity needs to pay attention to these issues. Now, if you are sitting in the room and you were like, this is all a lot of information hitting me at the same time, what do I need to do? Let me very quickly go through what I think you need to do. I think the first thing you need to do, you have already started doing, which is you are in this room and you are learning about it, or you are improving your knowledge about it. So continue doing that. I think the very first thing that you need to do is to do a baseline assessment, around your company. What are our sustainability issues? What are our sustainability risks? And what kind of sustainability issues do we have in our business? Very baseline, very, very baseline. And included in that baseline can be an initial gap analysis, a gap to what we need to report in terms of IFRS S1 and S2 and where we are now. It will be very baseline, but it's a good start and it gets everybody's juices going and it gets everybody to start thinking. Now, once everybody has started thinking, we all know that anything that nobody owns, everybody owns it. And once everybody owns it, nothing happens to it, nothing gets done. We all just talk, and talk. So it's important that you get your governance right. Okay, so we know that we need to take sustainability seriously. We're reporting on IFRS S1 and S2. We need to get governance and the champions. When I say the champions, I mean the folks within each business entity that is an opportunity, each business entity within your company that is an opportunity space or a risk space. The champions within that space that are taking it upon themselves to be the sustainability connect for that business entity, for that business unit. Then the governance around it, as in on your board, in your management. If you go and read the reports of early adopters from Seplat to MTN to Fidelity to Access Bank, you will get some ideas of the various governance structures that are at the top management level and the governance level. There is no right or wrong. It is what is right for your company. Then you need to start talking about your materiality assessment and your strategy. Now, your materiality assessment is not what you think is your materiality assessment, what our topics are material to you. That is very important. But your stakeholders, what do they think is material? What do they think are the material issues in your business? It's very, very important that you do that stakeholder assessment and you start thinking about a strategy around that stakeholder assessment. What are your targets and your metrics? Remember that we said you're going to have certain targets, you're going to have metrics by which we will measure, by which your report will tell us how we will measure how you are doing. So if you take a Seplat, for example, I'm using Seplat because it's an early adopter, not because it's the only one that has this. Seplat has said, we will be net zero by 2050. That's a target. They already have 2050, more ambitious than Nigeria, which says we will be net zero by 2060. So what are the metrics by which we will measure that you will be net zero by 2050? Then risk integration, that's what I spoke about before, integrating the risk into your risk management framework. After you've developed all these risks, so we have a risk around a physical risk around flooding because we have a warehouse that is a very significant warehouse that is in X. We have a transition risk around the Nigerian Climate Change Council has said certain things, and we may be potentially penalized because of that, and so on and so forth. Data and controls, I cannot say this enough. Your sustainability is only as strong as the data you have. And data is where a lot of people get it wrong. A lot of people are doing things that are relating to sustainability, but they're not, the information they have is not auditable. The information they have, they can't be sure of the integrity. The information they have may not be in a format that is usable. And so you need to do a deep dive on the data that you have, the controls that you have around it, because remember, you will be reporting. And this is good for your business as well, that you know what your data is, you know the data that is missing, you know the data that you need to keep, and you also have the appropriate controls around it. It's not just for reporting, it's important. And finally, disclosure and assurance. And that's where you're getting into, how am I going to actually represent my story? using the IFRS standards. And because the roadmap also has assurance, there will be assurance in the fifth and sixth years of certain things, limited assurance, and after from the seventh year, reasonable assurance of certain things. I'm not going to go into details, but I can use the chat box after this. I think that I have used the time that I have, and so I will stop here. Thank you very much. Over to you,
Thank you
Eloho.
very much, Tino. Yeah, thank you very much, Tino. That was an amazing presentation. Virtual claps for Tino Ade, please. Yeah, let's keep our reactions coming. One line from your presentation that actually stood out to me is sustainability is not esoteric. Thank you very much for that. Amazing presentation, Tino. If anyone has any questions for Tino Ade, please drop it in the chat. We are going to attend to it in our Q&A session. Now that we have looked at the standards and the reporting side, we want to ask what move are available for organizations to understand sustainability and what it actually means for their business. And our next speaker is Sheriff Aliu, who is a sustainability and climate specialist. His work spans climate action, sustainable agriculture, systems thinking, and program evaluation. And then today he will be taking us into sustainability as a growth strategy, unlocking new markets, customers, and capital. Sheriff, we are looking forward to hearing your perspective. Over to you. Virtual claps for Sheriff, please, and our reactions. Thank you.
Yeah, thanks a lot. Thank you for having me. I'm just going to share my screen. Please do let me know when you can see my screen. Okay, can you see my screen?
Yes, Sheriff, we can see your screen. You can begin. Thank you.
And also, Laura, can you stop making me a co-host, because I'm seeing a lot of notification also. I think that's not helpful, like Tina talked about. So again, thank you everyone for having me. My name is Sharif Ali, and today I will be talking about sustainability as a growth strategy, unlocking new markets, customers, and capital. And basically, I think it's useful when you think about this to start from an etymology point of view. And when we go back to like the 1987, the Brundtland Report, which popularized the term sustainable development. And today, one of the broadest and the simplest definition of sustainability, which Tino actually referred to earlier, this idea of maintaining the present, meeting our present needs without harming the future generations. I think it's always very useful to start from that. And the issue with that, when you think about that, is that it frames sustainability as a good thing. It is a good thing. It frames sustainability as the right thing to do, but not the best thing to do. And when you're thinking about this perspective of moving sustainability or using sustainability as we are thinking about the perspective of using sustainability as a growth strategy. Sustainability cannot be built on head to zero, because what that does, when you think of sustainability only from a morality point of view, is that it sits in the same mental frame or the same governance frame as philanthropy. So it's something you do when it's good, when the times are good, and it's the first thing you let go when you're having the kind of issues. And depending on the kind of personnel that you bring in, that also affects your sustainability. So fundamentally, first and foremost, when we're thinking about sustainability as a growth strategy, you have to think about it as ethos, but you also have to think about it as strategy. And what that does is that it ensures that sustainability ends its place on the same terms as any business strategy. thinking about revenue, thinking about cost, thinking about risk, and thinking about access to capital. And because it is tied to value, it ensures that it sticks, it stays, and it sustains. And there's a number of things that's happening, a number of imperatives that is forcing that to happen, that is moving sustainability from the goodness of our heart. Again, we have to move sustainability from the goodness of our heart here to the balance sheet. A number of things that are making that to happen right now. First and foremost is the IFRS standard that Tino just presented. It is forcing us to think about sustainability from that dimension because it reinforces and ensures that when you think about sustainability reporting, it has to be thought about in line with your financial statement, connectivity to your financial statement. So you have to think about your risk and opportunities, but also what does that mean for your three-statement financial statement? What does that mean for your revenue? What does that mean for your cost? What does that mean for your asset and liabilities? And even what does that mean for your cost and capital? That imperative is driving this understanding that beyond ethos, we have to think about sustainability as a strategy. And in this case, as a growth strategy. There's also a demand revolution. Of course, buyers now impose sustainability criteria as a condition of doing business. And even individual consumers, sustainability is one of the considerations. And that's a little bit complicated, right? You see a number of studies that where buyers are saying, I consider sustainability when I want to buy something. And when you then actually look at what they buy, it's not a sustainable product, quote and unquote. But what is actually happening is that sustainability is one of the prime considerations alongside price and quality. And depending on how individuals are along the sustainability journey, it determines the way that you allot it. So there is a demand revolution and also a capital shift. Financing is repricing around performance, and green and sustainability linked instruments tie cost of capital to result. Those imperatives are driving this connectivity of sustainability to the balance sheet. And how we think about sustainability as a growth framework, and how do we even think about it at Union Crest, for instance? It starts first and foremost from this idea of fundamentally doing things differently. That's where you start from. The things you have been doing it differently, and then you move to doing different things. And that's where a lot of people get it wrong. They always start from doing different things and just leave what they have been doing. So if you're thinking, yeah, you're thinking about your organization, you're thinking about your firm, which you represent, and even as individuals. And that's what at the micro, at the macro level, at the firm and an individual level, when you want to leverage sustainability as a growth strategy, it does start from what you are currently doing. How do you do that differently? Putting the lens of sustainability into it to move into doing different things. And when you also like split that into, you do like a deep dive into that, you slice and dice that. Research from a lot of university, Harvard, MIT, and even consulting companies, some of the biggest names, they all agree. Rarely do they agree, but they do all agree on a first-step process to doing that. And basically, you have to start from minimizing costs to optimizing efficiency. Let's be getting into the how, to then thinking about new products and technology, and ultimately new business models. So the first two is really about protecting value in an incremental way, solidifying your base, your fundamentals. When you're thinking about sustainability, you want to leverage it as a growth strategy. You have to start with your risk and opportunity mapping. And from that, think about solidifying your base, minimizing your costs, optimizing efficiency before you then go out aggressively to pursue those opportunities of creating value, which revolves around new products and technologies and new business models. And we can look at a number of these indeed, some case study examples of that. So when you think about minimizing costs, what are we talking about? That's the lowest hanging fruit and where you should start from. Again, thinking about doing things differently. And growth emerges by you're cutting the very common categories. You're thinking about your waste, you're thinking about your energy, you're thinking about your waters and materials at the source. You're thinking about how can I reduce this? How can I reduce source level waste and pollution? What kind of materials can I substitute that's cheaper? Material substitution and input reduction. You're also thinking about when you do a number of that, you're also thinking about environmental cost accounting to make some of these changes quite visible for you. In times when to put a dollar value on some of these savings, thinking about your energy and water efficiency retrofit and recycling and use of the processed materials. These are the kind of things that you are thinking about. And a pretty good example of that when you're thinking about here in the United States is more recently is Nestle Purina. Nestle Purina, it's a pet food factory in Georgia. What they did is not something, when they want to start working on sustainability to grow their business, they didn't start from something glamorous. First and foremost, what they did was they had like a factory floor program where they worked a lot more on their reclaiming system. They kind of retired their unused water lines. They reduced their operating pressure because they did some tests and realized that they could actually achieve the same thing with lower operating pressures. Worked on how they will recover their condensate from the umbrellas. And what that happened was recognized in the US, the EPA pollution prevention program was they were able to save 66 million gallons of water. And also they were able to save about 2 million kilowatts hours of energy. And in times of savings, when it was costed, it was about 760K. And that was really starting again from the lowest hanging fruit. And then when you start thinking about optimizing efficiency, this is a little bit confusing, right? Because they kind of overlap in some ways. But the fundamental difference, right, when you think about this is you're thinking about minimizing costs, you're thinking about reduction, right? You're thinking about one-off savings. When you're thinking about incremental savings, when you then move to efficiency, a very good example to understand that is when you're thinking about saving costs, you're thinking about reducing your waste. But with optimizing efficiency, you're actually thinking about eliminating waste. Redesigning your process to move around to something like zero waste and closed loop process design. You're thinking about your product and packaging design. You're also even thinking about your portfolio pruning. Uh, do we want to risk? Do we want to exit like every the kind of some of our portfolios that are very prone to heavy fines? Do you want to exit that? And you're beginning to use a lot more scientific and empirical methods, thinking about life cycle accounting, life cycle costing, and all of those. Building that into the systems, and they are also like very good case studies of that. Very good one was General Motors. If you look at General Motors, waste was a very good example. So what General Motors did was, after going through the first stage, oh, they reduced our waste. The second stage was really about they looked at all of the waste that they have. You want to optimize for efficiency, right? And they looked at every waste stream across the plant and asked, oh, what's the what? What's the value of this waste? When we start thinking about this waste as a commodity, there's an entire literature on the commodification of waste, the value that's attracted to waste, right? So what's the value that we can actually generate from this waste? And basically, they put a dollar value on that, and then they design the operations to reuse, to recycle, and convert to energy instead of sending them to landfillings. And what they did achieve with that was they had about $1 billion generated from recycling since 2007. You can find that in the sustainability disclosures. They had 2 million tons. Just wanted to take this notifications. They have 2 million tons of waste diverted every year, and their waste management costs are reduced by 75% from 32 million to 8 million. So you're moving from, again, cost savings to optimizing efficiency. And then to the third stage of new products and technologies. And that's really where it gets more interesting and where a lot of organizations always get it wrong when they're thinking about sustainability as a growth strategy. They move straight to new product and technologies. And that's not really where you want to start. And it is the inflection point. So the first two was really about solidifying, you're protecting your base, you're protecting your value. And this at this point, you really want to start creating additional value that you can leverage in for growth. You really want to start going hunting of those opportunities. But importantly, before you do that, you're not leaving any money on the table. You've done the first two processes. And this at this stage, that's when you're really thinking about, oh, you embedding sustainability targets into your R&D. So you have a R&D department and saying, giving them sustainability targets. You have to come through with this kind of product that we are thinking about based on our understanding of the market and regulatory pressures and consumer demands. So you commercialize breakthroughs and clean technology, you think about stuff like that. You stop finding savings at this point, but you're finding products. So at this point, you're chasing revenue and not cost. And this is at the point where you move to the next level. And finally, and a very good example of that is a company here in the United States, not too far from me, Interface also. It's a carpet tile company. And they spent about 2 decades, this company, on those first two stages of, oh, we're saving costs, you're working on efficiency. After spending almost 20 years on that, in 2019, they came out and invested $100 million in carbon storage materials and manufacturing process. And the following year, they actually launched the world's first carbon negative carpet tile. So basically, it's a tile that um, by the time you make it, you're done making that carpet tile, there will be less carbon in the environment than before you actually made it. So it was a carbon negative. And what that happened was it became the European standard for those kind of products. So they were able to actually move into new products. And finally, new business models. Are you moving from products and differentiated value? Um, in the final stage, you stop thinking about sustainability as a feature. Your entire business model entirely becomes sustainability, and that could mean a number of things for organizations. For some companies, it could actually mean creating a new company, actually, then moving into like an old goal structure where you have that new company that's sustainability focused. But for some other company, it could actually also means like changing the entire business model of the company, finding working in an entire different way. And we've seen various examples of that. We see companies, they reinvent their core business around the sustainability proposition. They build new market and brand leadership, and they convert sustainability into durable competitive advantage. One pretty good example that comes to mind when you think about that is this company called Oster. It's a Denmark case, just moving outside the American context. And this company used to be the Danish oil and natural gas, and it's one of the most coal-intensive utilities in Europe. As a matter of fact, when they do attributional carbon cost accounting, this company was credited as being responsible for almost a third, like 33% of Denmark's carbon emission. And in 2008, what they did was they made a decision that most companies do not make. They actually exited, and then they started an offshore wind business. So and become at that point in time fastest growing and one of the most profitable wind business. So they actually moved from oil and gas to wind energy and entirely abandoning the oil and gas business. And that's really the last stage when you're thinking about leveraging sustainability as a growth strategy. And again, just to summarize, basically you're thinking about it from four perspective, even fundamentally. You have to think about sustainability, to be able to leverage sustainability as a strategy for your organization, you must complement your sustainability as an ethos with sustainability as a strategy. It's not enough to just think about sustainability as something that you do from the goodness of your heart. And when you want to start operationalizing that, you have to start from what is in front of you, which is and do that differently to doing different things and go through the first step process of minimizing cost, optimizing efficiencies, working with new products and technologies, and finally new business models. Not all companies will be able to walk the entire fourth stage over their lifetime for a lot of reasons, resources, priorities, and so many things. But over the course of a company's lifetime, you're better off working around some of this. And with that, I'll say thank you. I'll take your questions.
Thank you very much, Sharif. Thank you very much for Sharif. Virtual reactions for Sharif, please. That was amazing. Thank you very much. And I think it's important to bring home that sustainability isn't only about managing risk and meeting requirements. It can also be used to create opportunities and for businesses to grow, innovate, and then remain competitive. So thank you very much, Sharif. And with that, let us have our next poll. Yeah, it's on your screen now. So our next our next poll: does your organization currently view sustainability as a growth opportunity? Again, there are no right or wrong answers. We just want to, know where organizations actually are right now. Thank you. While your answers keep coming in, um, we want to introduce our final speaker, Sanne Kim. She is the principal consultant at Green Horizon Advisory and formerly the head of sustainability management and ecosystem development at Bursa Malaysia. May led the development of Bursa Malaysia's inaugural ISSB sustainability statements, including early adoption of the IFRS S1, and played a key role in developing its enhanced sustainability reporting framework. May, we are very, very delighted to have you with us. The floor is yours. Virtual claps for May, please.
Okay, thank you, Elahor.
Thank
Can
you.
I just check? Can everyone hear me?
Yes, we can hear you loud and clear.
Okay. Excellent. Okay. I understand we are a bit ahead of time, so let me see if I can steal back a few minutes so that I can return it back to you, the participants, who definitely have very interesting questions coming in. So firstly, good morning, good afternoon, and good evening, depending on which part of the world you're from. And thank you, of course, to Union Crest Capital for the kind invitation to share insights from Malaysia's ISSB journey. So we have a fair bit to cover in what I hope to be about 12 minutes. So let's jump into it. So to share a bit of context about Malaysia, I'm not sure if many of you are familiar where it is. It's the country in between Thailand and Singapore. People tend to go to those two places and skip us altogether. That's Malaysia. So in terms of ISSB adoption for Malaysia, what we did was the government launched the National Sustainability Reporting Framework in 24th September 2024. So our framework came out later than Nigeria's FRC. The way we're doing it is we have a phased implementation approach. So what you see is that we have three groups here: Group 1, Group 2, and Group 3. Group 1, Group 2, Group 3. So the first one is our main market listed issuers, which is 2B and above. So these are large caps. They started reporting in 2025. 2025. So 31st December of last year, we saw our first cohort of mandatory reporters, 91 companies in total. So as you're aware, actually, the ISSB standards are not so straightforward to implement. So what you will see is that the government has also introduced a set of reliefs. So if you see these three little dots here, the yellow dot, turquoise, and purple, those are actually the reliefs that we have. So in a nutshell, it goes like this. For the first 2 years, our companies only need to report climate, IFRS S2. We only need to report for principal business segments, and we do not need to do scope 3. That's for the first 2 years. But come 2027, the entire avalanche comes. We need to do full S1. We need to do scope 3 in full, and we need to run that for our entire business operation. In terms of assurance, our regulators are very, very ambitious, I would say. So they are aiming for reasonable assurance for scope 1, scope 2, starting 2027. But they're looking at reasonable assurance for S1, S2 in about 2 years after that. So this one is still under public consultation. If you ask industry is a bit divided because limited we have seen in different jurisdictions, but reasonable would be very challenging. So in a nutshell, I've covered Group 1. So we have a first set of reporters and then moving to 6 to 7. Group 2, which is the rest of our main market, they start 2026 and they have the same runway. ACE market listed issuers for us, Group 3. For this, you're actually looking at our secondary market. And of course, large non-listed companies. They start 2027, but they have a longer runway to 2030 before they eventually have to do the full suite. So these are the reliefs. I will not cover them in detail. So this is what I'd like to share today. In terms of the key lesson from Malaysia, it would be the materiality assessment that most of us are struggling with. So, as Madam Tinu shared earlier, this is a financial focused standard, investor/financial focus. So, in other words, how do you know what do you need to do to report under these standards? So, in other words, which topics? So the question here comes, let me do a bit of theory. If you look to the left of your screen, you will see the extract from IFRS. So essentially, it asks you a question. Does this sustainability matter affect the entity's prospects? In other words, does it affect the cash flow, access to finance, or cost of capital? Does it affect any one of the three over the short or medium or long term? 3 views. Either one you hit, you have to do ISSB standards for it. So if it's a yes, you will report the material matter, or SRO, sustainability, risk, and opportunity, using the ISSB standards. If no, then it falls outside of the standard. In other words, you're free to report using GRI, any other standard you like. So if we move to the right side of the slide, we'll actually be looking at what's happening in our jurisdiction. So Malaysia is a double materiality jurisdiction. Before this, most of us were reporting against GRI. So GRI is the more, I would say, it's the older and more established standard. The ISSB is a fairly young standard. So we come from a double materiality regime where this matrix that you see here, I suspect is familiar to some of you. You would actually seek out your stakeholders and you will ask them to rank the importance of the items on, let's say, a scale of 1 to 5, 1 to 10. Then based on that, you plot them on the graph. So then you will end up, typically in Malaysia, you'll see every company lands with about more than 10 material matters. So here I've just listed down a short menu of something across E, S, and G. So there's a bit of environment here, social, and then of course there is governance. Now, for those of us who are moving to the ISSB standards, we are suddenly moving to a single materiality standard. So before this, we considered dual views. We looked at outside in, that means does floods do any harm to me? Does carbon tax do any harm to me? To an inside out, where I'm looking what externalities does my company create? So that means waste. I generate waste. What do I do for my community investment? So it used to be 2 directions. Now, with IFRS, it is 1 direction, only single materiality. It cares only for 2 questions. Does this bring me a lot of money? Or does this cause me a lot of harm, where I'm going to spend a lot of money? A lot of income, a lot of damage. These 2 questions. So if we look to the rightmost quadrant, so you'll see here a set of SROs, sustainability risks and opportunities, that are typically shortlisted by Malaysian entities. So let me first explain them. Climate. Climate for Malaysia, unfortunately, it's mandatory whether you like it or not. In other words, if someone looks at floods, looks at carbon tax, and they determine it's actually not financially material, our government doesn't really care. It's mandated for us, IFRS S2. Now, the other 2 are interesting. So if we go to human rights, let me just explain how the thinking process works. In the case of human rights, Malaysia is a trading nation. So we also trade with countries like the US, UK, who have custom border protection. So what typically happens is that if an allegation is lodged against the company, immediately they are sanctioned and no goods can enter the country. In other words, you are guilty until proven innocent. I repeat, you are guilty until proven innocent. So what happens is a company, regardless of their controls, no matter how good the practices are for human rights, as long as an NGO lodges a complaint, immediately the goods are sanctioned. What we have seen is that for companies with better practices, who better manage the risk, they actually get out of the list within a year. But we know of some companies who have been stuck there for a few years. So that's why this is typically shortlisted if the company has any foreign labor in the supply chain. Simply because despite the company's best efforts, it just takes a single letter, a single allegation letter, and you will see a sanction. The next one is cybersecurity. I'm sure this one comes as no surprise to everyone, simply because in the age of AI, what you see is more and more things basically pop up, and you need stronger cybersecurity. There's a joke that we have that if the companies are learning and they're doing better, the hackers are equally better. They are equally doubling up their efforts. So the question is, if there's a gap that always can't be covered, then that risk persists. So that's kind of the insights from Malaysia. Let me cover next one. So I was asked to actually share what would be the best first step for a company who wants to start on the ISSP. It took me a while to think of one, but to me, this is actually the critical first starting point, and it builds quite a fair bit from Madam Tinu's presentation earlier. Lock 4 functions into a room: sustainability, risk, finance, and business units or strategy. Gone are the days where the sustainability function can unilaterally, single-handedly alone manage this report or manage this business risk. It is not the case. So to clearly go, let me explain. You realize from the materiality assessment here, you need to look at impacts, entities, prospects over short, medium, or long, right? For current, you are looking at current year financial statements. Short term typically ties into your budgeting cycle, medium to your business planning cycle, and of course, long-term horizons to your risk cycle. So this is what you need. You need close collaboration. You need to lock the 4 units in a room and have them discuss this quantification until they can land. So to quickly go through, current year expenses, for instance, if I have a HR sanction, I have fines, it would be in your financial statements. Was it tagged? Green revenues, am I selling any carbon credits this year? What was my revenue? CapEx, did I build any solar on my roof? Is it tagged? Budgeting cycle, if I intend to spend on these items, do I actually have them tagged? For instance, like if I'm going to get more EV charging stations, is that even put in? Then we look at long-term, short, medium, long. So the risk function needs to look at cybersecurity attacks. How often do they think this will happen and to what magnitude? If you look at revenues, you're looking strategy, business units. How much are they expecting to make and by when? And last but not least, when you look at budget tagging, what you'll actually see is once you reach the far end, so the corner of the screen on the right, it becomes unable to estimate too far into the future. So this is what we observe. This is how companies in Malaysia actually did it. We form working groups consisting of these 4 functions at minimum. And the companies, basically the functions sit and debate until they can arrive at numbers. How much do they believe this risk is going to cost us? How much money do we think we are going to make? And you'll be surprised how many of these conversations turn into very strategic ones. Because ultimately, the last message I would like to leave with you is this is not a reporting requirement. It's not a compliance requirement. It's actually a process that teaches companies to really internalize the sustainability risks and opportunities. So you actually need a plan on how to mitigate these risks. And of course, you also need to, if you have opportunities, you definitely need a plan on how you want to capitalize on them. So with that, I wish you all the best on your sustainability journey, and I return the floor back to Elahor.
Thank you very much, May. Virtual reactions for her, please. That was really, really insightful. I think that's a really useful way to look at the journey, understanding the requirements, see the opportunities, and then take the practical next steps. So with that, we just want to take the last poll. Our last poll. Okay. Yeah, that's launched. So if you were to take one action after today's webinar, what would that be? Just take a moment to respond. And while that is ongoing, I would like to briefly go into the Q&A session. We have been collecting questions throughout the session, and then I will direct each question to their speaker. So the first one, Tinuade, let's start with you on this one. How can organizations turn IFRS S1 and S2 from a compliance exercise into strategic process, particularly by linking sustainability risks and opportunities to financial performance, capital allocation, and board level decision making? Tinuade?
Okay, thank you very much. So I um, basically the first thing is to see that IFRS S1 and S2, they're report them from reporting and compliance to say, okay, I want to do things where you are basically embedding business decisions into the whole idea of IFRS S1 and S2. And what do I mean when I say that? It means that you're embedding your sustainability considerations into your enterprise risk management, into financial planning processes. In other words, you're not treating it simply as a reporting issue. You're basically thinking about them in terms of how do I allocate my assets? What do I invest in? For example, if I'm an insurance company, as an insurance company, I would want to you know, my book of insurance, my book of insurance to be big so that I get premium into the insurance company. But if I'm thinking sustainably, I'm thinking to myself, first of all, is that I'm going to be covering certain risks. What are those risks? And how many of them are sustainability risks? And so I'm looking at my book and I'm thinking to myself, I want to reduce the number of sustainability risks that I'm covering, or I want to cover only certain types. And so in my strategy, I'm already thinking not just that I'm going to go out there and do general insurance, but that because certain sustainability risks may be more problematic in the future in terms of payout of claims, I'm already thinking about my strategy around them. Let's even go to something less.
Okay, apologies for that. I think Tino has issues with her connection.
I'm so
Let's go
sorry.
to the next question. Oh yeah, thank you, Tino. Maybe you can just drop the reply in the chat so that it will be easy to follow up. Let's go with the next question, Sherif. Please, briefly, can you just help us understand how organizations move beyond simply reducing waste and create a truly circular waste management model that prevents waste at source, maximizes resource recovery, and delivers measurable environmental, social, and financial value?
I mean, that depends a lot also. Like, that's a very specific targeted question. That's very difficult to answer from the industry agnostic perspective. So, like, depending on the kind of organization, it's different strokes for different folks, right? Depending on the industry. that you are dealing with, and also the kind of ways that you're actually dealing with. That's what's going to determine what's like the best approach, and whether it is actually, because when you think about waste management, there are different angles to it, right? There is the waste reduction to it, there is the waste repurposing, and also even there is the zero waste approach. But there are some industries that it's inherently impossible to actually avoid waste. It then becomes a case of how do you actually manage that waste. But depending on the industry, would actually determine. But just to give some specific examples of some of the industries that I know very well, for instance, agriculture, right? If you think of waste in agriculture, you think about controlling environment agriculture, the number of things that you can do with your loop. You can actually make your water to actually be recirculating. So you move from instances where you need, let's say, 50 liters of water to actually grow 1 kg of lettuce to about 2 liters of water because you switch to a recirculating systems. So the water is not going into the soil, it's actually just recirculating. And so depending on the kind of industry that you are and the kind of waste um, that you actually produce, that would actually determine what's the best. But you have to think through those 3 stages of reducing, repurposing, and eliminating if it is possible.
Mm-hmm. Mm-hmm. Thank you very much, Sherry, for that. Given that we are well ahead of our, arranged time, we'll just take one final question. How should businesses determine which ESG issues are genuinely material today, balancing their impact on enterprise value with their impact on people and the environment, and ensure those priorities drive measurable actions rather than becoming a reporting exercise? May, would you like to jump on this for us?
Yeah, let me just give a short and sweet answer. If you're talking to management and they can't sleep over it, then that's a good risk to shortlist. Because trust me, if something's affecting your P&L balance sheet, it's on your KPIs. But I will share this one insight from Malaysian companies. When we did our assessments, many of us were surprised that rather than risk, we started identifying a fair bit of opportunities. That means this is where we think it will actually make us a fair amount of money, maybe not in the short term, but in the medium and long term. So just to parry off Sheriff's initial comments, I mean, there is a lot for opportunities as well, and I actually feel that's something that's often lost because once the accountants and risk people take over, like when they crowd the room, you will really see that it suddenly becomes very negative. But just give a chance to opportunities as well. Yeah, just for that balanced view. Thanks.
Oh, thank you very much. Thank you very much for that responses. If you have questions, you can drop them in the chat. We would follow them up on your email. And with that, we have come to the end of today's session. I think we've taken quite a journey. So I want to say a very huge thank you to our speakers, Tinuade, Sheriff, and May Kim, for sharing their knowledge, experiences, and practical perspectives with us today. And to everyone that joined us and participated in the polls, that dropped their questions in the chat, we want to say a very big thank you. Thank you for staying with us throughout. We hope that today's webinar leaves today's conversation leaves you with not just more information but a clearer idea on what your organization can do next. So to stay connected with us and receive our updates for our upcoming webinar and insights on sustainability conversations, please follow us on our social media at link Union Crest Capital Limited. So you can follow us on LinkedIn, on X, and on Instagram. You can also visit our website on www.unioncrestcapital.com. Once again, thank you very much for joining us. I am Eloha, and this has been a pleasure, guiding us through the conversation. Do have a wonderful day, everyone. Bye.